Santa Barbara, California, average August weather. Okay, now we're ready to go. You don't want to put a shirt on? You want to show your muscles today? Hey, wow, look at this. Wow. Now you look like a professor. Now I have to put a better shirt on. So I look okay. All right, Josh, here we go. You ready, buddy? Let me get the share screen going here. You been keeping up with the homework and everything? Oh, you're mute, Josh.
There you go. Yeah, I've actually been doing better with the homework. I completed it on time this time.
Good.
And I did have some questions about the homework. Well, I mean,
Yeah.
I did it all completely and stuff.
Yeah, we can attack those now if you like, whatever you like to do.
Well, that's the thing. I kind of forgot the questions, so I'm looking
Okay.
at the notes I did, and I'm
Yeah.
just trying to refresh my mind. I just came out from the gym. That's why. Sorry.
Yeah, I go to the gym on Tuesday and Thursday, believe it or not.
It's good. It's good. Any little bit of exercise helps. That's the way I see it.
God. Yeah.
Okay, beginning cost inventory. Oh yeah, well the original question I had after actually writing the notes, it kind of cleared up for me, was the LIFO reserve. But then I realized it's just FIFO minus LIFO, right?
Yep.
Okay.
And then it gets adjusted every period.
Okay, yeah.
Yeah.
And then yeah, because I was I had that question for the current ratio, like how did they find the FIFO current ratio? But it was
Yep.
basically you just add the LIFO reserve.
Yep. There's always going to be a difference between them that needs to be adjusted to match the tax records. That will not be on. I don't think that's going to be on the test at all, to be honest with you.
Okay.
I doubt there'll be any questions about it. You might notice I skipped over that in class.
Yeah, I remember there was stuff that you skipped over that
Yeah.
when I was doing the assignments, I was like, this reminds me of something that we're not gonna worry about it.
Yeah.
I do remember the question I had, and it was for the inventory turnover.
Yes.
So in the book, it has like just an example for like 2 years. So it says like 20 to 2021, and then they used those two numbers that they gave us.
Right. Let's understand that. Yeah. The inventory turnover is the cost of goods sold divided by the average inventory. So when they're giving you 2 years of inventory, they're saying that the balance at the beginning of this year was this amount, and the balance at the end was that amount. And we're averaging those two.
Okay.
You're not looking at 2 years of turnover. You're just looking at 1 year of turnover. But you need the beginning and ending inventory to compute that turnover.
Okay. Yeah, I was confused on that part because in the homework, or I think in the pre-lecture assignments, it had like for you to calculate for 3 years, and then it gave you like different ending inventories.
Yes.
So I kept trying to do just how like I saw in the book, like using from 1 year and then using from the next.
Yes.
But I was getting the answer wrong, and then I thought the average was adding all three, but then I still got the answer wrong.
Yeah, that wouldn't be right. Yeah.
And then I found that, well, basically I ended up realizing after getting all the tries wrong, and I checked the solution, it used the beginning and ending for the same year.
Yeah. Sometimes they confuse you by calling it the balance at December 31st, 2016 versus December 31st, 17. But I think a better way to remember, Josh, it's the average of January 1st versus December 31st.
Okay. Yeah,
that would represent the 2 years, if you will.
Okay. And then the only reason The only reason in the book it had the following year was just because that's the beginning inventory for the next year, which therefore would be the ending of the year before, right?
Absolutely right. I'm glad you picked
Okay.
up on it, because that's exactly what I was gonna say. A beginning inventory is the same as the ending inventory of the period before.
Okay, perfect.
Yeah,
Yeah, that was
yeah, yeah. And then you know how to turn that, then you get a turnover and you know how to turn that into days, right?
yeah. And then
Divided it.
days of inventory.
Yeah. Okay, what else you got?
Well, the other one that was kind of tricky for me was what would happen when the beginning inventory or ending inventory was understated or overstated.
Okay, let's talk.
But I went along and I put the whole little chart in my notes, and it was just confusing on how the questions were worded. So I had to be like really careful of like
Yeah,
who it belonged to.
yes,
But that all got kind of cleared up once I
yeah,
wrote my notes.
yeah,
And
yeah. Yeah, that'll probably be on the test if you question. If you understate the inventory, you understate the profit.
yeah,
Okay,
cost.
which means you're going to overstate the profit the next year. And the reason for that is, Josh, and this is for the whole class as well. The reason for that is you now are stuck with a bad ending inventory, right? Now you're bringing that bad ending inventory as the beginning of the next year. So you're starting the next year off wrong as well. So if you undercounted this month, you're going to be looking the opposite way next month automatically.
Yeah.
And that's the key thing. Where I used to work, we had a lot of what was called intercompany accounting among the divisions of the company. And one time somebody screwed up all the intercompany accounting. So our records for the whole company were wrong for 2 years. And so were the records of half the divisions of the company. So
Wow.
yeah, you want to count accurately if you can.
Yeah. Keep that noted.
Yep. You ready for the lecture? You got some more questions?
No, I'm good to go.
Okay. This chapter here, this is a warning for the whole class. This one's kind of a dull thing until we get into the bank recs, but it's some low-hanging fruit for the test, I think. We're going to talk about fraud and internal controls. Then we get back into some numbers. You know, define fraud. I think we know what fraud is. What this book wants to emphasize is, though, how does a good person go bad? A dishonest act by an employee that results in a personal benefit at the cost of the employer. That's what they're calling fraud. And there's three things: financial pressure, opportunity, and rationalization. And I think that's so true. And I'll give you a couple examples as we go along here. Write this act down. Sarbanes-Oxley. This law came out of the Enron scandal of 23 years ago, the largest corporate bankruptcy in American history. It was accounting fraud that did it. 3 people went to jail. And in those days, the executives of the company, they didn't even have to read the financials. They could say to the world, "Oh, I don't know how to do these financial statements. I just sign them. You know, Josh is the accounting guy. Go to him." You can't do that anymore. With this law now, they have to have a good system of internal control. Corporate officers and executives, they must ensure that these things work, and the outside internal auditors have to attest to internal control. What are internal controls? Internal controls, systems to keep your assets safe, basically, okay? And they can be very complicated to the very, very simple, and the very simple are the ones that probably are the most effective. Internal control is used in a business to enhance the ability to safeguard your assets, huh? And they're talking about 5 different things here: control environment, risk assessment, control activities, information and communication monitoring. Let's just look at these kind of briefly here. Internal controls. One of the most important internal controls, Josh, is have more than one person involved in a process. The minute you have one person taking over everything of a particular process, It can tempt the person. Remember our triangle about fraud? There was opportunity. So don't give employees opportunities. So one of the first things is, since this chapter is about cash, you don't have the person deposit the money in the bank who also records the money into the financial records. You don't have the same person maybe open up the checks in the mail in the morning. You don't have the same person do the deposit slips. So breaking out responsibilities is important. And what they're establishing here is establish who is responsible for what. Make that clear. And what I would just be talking about are the segregation of duties, that you split things up into different small bite-sized pieces. And you should have documentation. Look, another internal control of things like numbers on your invoices, as simple as that. And then physical controls. I always tell this story from Santa Barbara. It's a true story, Josh. I tell the whole class. About 20 years ago, there was a woman who worked for the police department here in town. She worked there quite a long time. She started right out of high school and she worked her way up to the point where they really trusted her to do a lot of things. So they gave her the responsibility for the computer system in certain areas, and they gave her the responsibility for processing speeding tickets. She was the only person involved in the process. She was honest as the day is long until they gave her this unexpected opportunity. So what happened, guys, you would get one of those pesky parking tickets on Shoreline, those $40 tickets, and you'd mail your money into the police department. This lady would open up the system, remove your ticket like it never happened, and keep the money. And she did. And as simple as that sounds, she got away with this for quite a long time. And I felt so bad when they marched her off to jail on television. But the point was, that was an example of opportunity, meeting rationalization. Her rationalization was, well, I'm only taking $40 from somebody. No, no good, no good. Physical controls. You want to use safes, obviously, things like that. Keep things locked up. A petty cash drawer, $100. You don't leave that on your desk open. Let's put it that way. You lock the thing up. Common sense types of things. Here's a good one in human resources that's kind of interesting. Some companies do this. Starting from the bottom, you conduct background checks. These days it's with the internet, it's easy to, check on somebody. It's not like in my day where you can tell an employer you graduated from Harvard and they wouldn't know it for a while, But now you conduct a background check. Does this person really have the degree? Here's an interesting one: rotating duties and requiring vacations. That's an important one in an accounting department. If you see an accountant in a business who never takes a vacation and then is there 5 days a week, 10 hours a day, that's an indication that there might be some hanky-panky going on. You might be kiting checks or dipping into the till and then paying it back a few days later. So you want to have employees take their vacations, and auditors will actually point that out. I've had that happen. Employers come in and say, so-and-so hasn't taken a vacation in 2 years. Make sure she gets out of the office next month for at least 2 weeks, and rotate the duties. One day you enter the money into the system. The next week, maybe you're the one who goes to the bank, that type of thing. Split the duties up. Management responsive data analytics. Skip that. Here, a little limitation of internal control. The cost better not exceed the benefit. In other words, we're not going to buy a $1,000 safe to lock up $100 worth of petty cash. There has to be a cost factor to it. And you got to take into account the human element, the size of the business. And here are just some of the things we were just talking about. Identify which control activities violated. So I'll trust you to go over this one, Josh, you and the rest of the class. But the person with primary responsibility for reconciling the bank account and making all the deposits is also the accountant. That's no good. Segregate the duties. One guy got an award for never taking a vacation in 30 years.
Okay, it's a hard worker.
He's a hard worker, or he's socked away so much money that when they catch him, he'll be in a non-extraditing company in country in no time. In order to save money on order slips, they got rid of pre-numbered order slips. That's nuts. Let's look at cash. That's what we're going to talk about now with the procedures. Again, we talked about the establishment of responsibility. Josh, you go to the bank. Bob, you fill out the deposit slip. Michael, you open, you get the idea. So segregation of duty, establishment of responsibility, and good documents. Cash receipt control. Here's an interesting one. I think bond personnel who handle cash require employees to take vacations, conduct back. Do you know what bond? You ever hear that expression? We're going to bond this employee before we hire them. Do you ever hear that before, Josh?
I haven't.
Bond. What it means is you're thinking of hiring me as your treasurer. Say it's a pretty high level job. Well, what you do is you go to a bank or an insurance company, someone who can investigate me a little bit, and they'll check me out, and they'll get back to you and they'll say, Bob looks like he's clean. We will bond him. Now, if I go now I'm bonded, if I go to work and then I steal $1 million, the insurance company will pay the company for it. That's kind of an exaggerated example, but bonding an employee means that you're covered for anything that he might do fraud-wise.
Okay.
Cash receipt control. Look at all these different things. Question?
Yeah. So say hypothetically you go to the insurance company and then they say, oh, we don't bond this employee, but then the company says, you know what, like he seems like he'll put in work and we trust, so we're gonna still hire him. But then say hypothetically I still steal $1 million and the insurance company didn't bond me, so now the $1 million aren't covered, correct?
Exactly right.
Okay.
Exactly right. Bonding is a pretty common thing with higher level people, I believe. We just take a quick belt here.
I'm gonna step into my kitchen and get my protein shake, but I can still hear everything.
Okay, I'll keep going. And he talks some more about the segregation of duty. And we've talked about this. Different people do different things. We establish responsibility. Who's in charge of what? Cash disbursement controls. Internal control over cash disbursements, most effective. You pay by cash is a bad thing. You want to pay by check and funds, transfers electronically. Voucher system, petty cash fund. We'll get to that. Again, you must be getting sick of hearing these same three things: segregation of duties, establishment of responsibility, and documentation. Cash, physical control. You lock it in the safe. And another control is you should be in a position to take the money to the bank each day if you can. You don't want cash to be piling up there for a week. All you see in the newspapers is somebody knocks off like a Taco Bell or a McDonald's. It's often an ex-employee who knows they only take the money to the bank on, say, Friday night. So they wait till there's a lot of money there. If you can, deposit every day. Independent internal verification, compare your checks and invoice. You see where it says reconcile bank statement monthly? That's going to be the main point of this chapter and what you're going to need to know for the exam. And human resources, we can bond people, make them take vacations. Pre-numbered checks, we know that's an example of documentation. Voucher system, just skip that. Control over cash receipts. L.R. Cortez is concerned about the control over cash receipts in its fast food restaurant, Big Cheese. Well, that sounds like a high-calorie restaurant, huh? The restaurant has 2 cash registers. At no time do more than 2 employees take customer orders and enter sales, and the shifts go from 4 to 8 hours. They want a good system of internal control, and one of the solutions they give you is a separate cash drawer should be assigned to each employee. You don't have employees sharing cash register. Did you ever run a cash register anywhere, Joshua?
Yes. Like not at an actual store, but I was part of like leadership in high school, and then I worked at a teen center, so we would like get it wasn't the actual register, but
Yeah,
they would give me money to pay for memberships, and then I'd have to place at a certain place.
there you go. So you get the idea. Yeah. So you wouldn't want two or three people to doing that besides you. The money disappears and you're all pointing at each other. You want
Mhm.
one person in charge.
One person liable as well, right? This way.
Exactly. That's good. You said it better than I did. One person has the responsibility and the liability should something go wrong. And they're giving Cortez all sorts of good solutions here. Okay, let's get into something that'll be a little simple at first, then we'll get into some good stuff with the bank rec. Control features of a bank account. It's good to use a bank. Who knew for business, huh? Instead of an old cash. My brother-in-law, sadly, my brother-in-law died a couple of weeks ago. He's such a nice guy.
Sorry to
He
hear
and
that.
his brothers ran a garage for forever back in Newark, New Jersey. And they had no accounting records at all, as far as I could tell. And they were strictly cash for the most part. It was amazing how that business did so well all a long time. But that's a real exception. You want to have a bank account and be able to write checks and have all the balances. Electronic funds transfer, we like them. We like them. There can't be too much fraud there. Okay, we've all seen, maybe we haven't, bank statement. The bank statement is a snapshot in time of our balance and all the transactions that the bank recognized. There will be things on the bank statement that we don't know about at the end of the month, and we have to record those. There will be things that we know that the bank doesn't know yet, and they become part of the reconciliation process. If you look up on top, they were always going to have the beginning balance, your balance per the last statement, and then the total pluses and minuses. There's your ending balance, and then the ending balance usually pops up again here on the lower right-hand corner, because you're starting with the beginning balance of, what is that, 13.2, whatever that balance is. And then you had the different activities through each day. Here, they're showing the deposits, all the deposits that went in a date. Here are the checks that you wrote. These are the thing. Here are the checks. Here, I'm sorry, they put the checks on the left. The checks coming out, and here's the balance changing each day. You see EFT, that's an electronic funds transfer. So, I mean, it's simple enough. That's what a bank statement is. You look at it and you say, yeah, that check, right. Bank statements show the checks paid and other debits that reduce the balance. Debit card transactions will be there, electronic funds. You're going to see direct deposits, automatic ATM activity. Bank statements will show bank service charges, NSF check. You know what an NSF check is? A bounce check. An NSF check was a check we didn't write. An NSF check is one we received from a customer. We deposited it in good faith, and then found out that the check bounced. Could you hold just one split second? This is my nephew.
No rush, no rush.
Yes, Steve.
Hey,
You want to put it on mute?
It's up to you. That's up to you. I'm in class right now. What do you got there? Anything of importance?
yeah, real quick. Does the water bill and sewage go to you in your name?
No, your dad's been paying that all these years. It's usually about $190, something like that.
Is it in his name then, or their name?
No, it comes here. I get the bill in the mail. I just throw it away.
Okay, so the bill is in your name.
I guess so. Yeah.
Yeah. Okay, that's what I need to know. All right, thank you.
I'll talk to you later. Bye
Give me
bye.
a shout later. Yep. Bye.
Bye bye. My nephew says hello. All right, here we go. Yeah, but an NSF check is a check our customers wrote that didn't have funds. when we reconcile the bank statement to our general ledger, we have to come up with two important things to start, Josh. Deposits in transit and outstanding checks. These are timing issues. A deposit in transit is a check that we maybe mailed to the bank at the end of the month, and it does not appear on the bank statement because the bank didn't get it yet. So that item is showing on our side as a plus, and it's not on the bank statement at all. That's an outstanding check, and now that's a deposit in transit, and we need to put it onto our reconciliation of the bank. Outstanding checks are the same thing, except these are checks that we wrote. We wrote a check on March 25th, payable for $100 to somebody. They put it in their wallet and they forgot about it for a couple of weeks. The bank statement came and we don't see that $100 check clearing the bank. That is another reconciling item. So we're going to have to add up all the deposits in transit and subtract all the outstanding checks from the bank balance and see if it matches us.
I have a question about that. And
Sure.
it's kind of more of also connected to like a personal matter. But
Yeah.
So basically, so say a company writes a check for an employee to pay for their wages. And then the check never arrives to the employee and it's basically still in transit, right?
Yep.
And the month comes in and the bank says, hey, well, no one's ever deposited that money, for your employee hasn't deposited that. Does the bank give like a semi notice to the company saying like there's a check that's still outstanding out there?
No. Because the bank can't possibly know the check is outstanding because they haven't got it yet.
Okay.
An outstanding check is a check that we wrote that just hasn't been cashed yet. No, the bank will never give you a warning on that. I guess they could now that I think about it, but I've never heard of that.
Okay.
No.
And
what? Go ahead.
Would the liability be on like the company, like the fault be on the company, the mailing service, or like say it just never arrived like to me?
Well, as soon as you find out that the check never got there, you would stop payment immediately. Okay. You would stop. You would not be responsible if it didn't get to the right person, unless the company made a stupid error or something. There's no real responsibility for anybody. But if someone mentions to you, look, I never got my check, a salesman, I turned in my expense report 3 months ago. Where's my $200 back? At that point, you would stop payment on the check because there's clearly something wrong.
Okay. You
would stop payment on the check and then replace it and make sure that it was put in the hands of your salesperson so he can, get the money right away. Okay. But yeah, that's a good question. Now, we're in the year 2022. When you go in to do your bank reconciliations, you're not going to do them like we're teaching here by hand. You've got QuickBooks, you've got Mass 90 and Oracle and all these different programs. And you're going to go in there and they're going to have a list of all the checks that you processed, right? All the checks you wrote. You're just going to click off the ones you see on the bank statement. And the ones that are not clicked off, they're going to be your outstanding checks. It's not like you have to write them down one by one anymore. So they make the bank reconciliation a little bit easier. But the thing is, you need to understand what the bank reconciliation is doing for us and what the accounting ramifications of it are. And looking at this screen here, this is a real important screen. Your bank reconciliation works this way. You're going to have two columns. One column for the bank statement, one for the general ledger or the books or the checkbook, whatever you want to call it. You see what it says here, Joshua? You're going to have balance per the bank to start it. Balance per the bank, say $1,000. Deposits in transit, 2,000, say, that's 3,000, minus 2,500 outstanding checks. That would give you an adjusted balance. They're calling it a correct balance of $500. Don't worry about bank errors. We don't have that on the test. Believe me, the bank doesn't make errors. The company makes the errors. Okay. I don't think I've ever seen a bank error, really, in my world anyway. But my point is, Joshua, just memorize this. I mean, not memorize, but just quickly understand. Bank statement, we tell the bank what checks they haven't received in the mail and what outstanding checks they haven't received. That'll give us the correct balance, okay? The bank statement, though, is telling us things we don't know. The bank statement is saying, well, we're saying to ourselves, our balance is not the same as this. This is our balance. Now we open up the bank statement and we see they made an electronic collection. We didn't know that. We add that to our books. Uh-oh, a couple of checks bounced. That's not good. We have to record that. There's probably going to be charges on the bank for maybe for interest, maybe for a monthly bank fee we might not know about. And the company will make errors. You write a check for $95 and you accidentally type in 59, that type of thing. And when these two balances equal, you have adjusted your bank reconciliation. Okay. I'm going to go on and babble a little more. Bank reconciliation may be the most important internal control of them all, because if you keep up with these every month and you're balancing out, you have accounted safely for every single dollar, every penny of cash available. And they're giving us.
So I have a question about the NFS that bounced.
Yep.
So how it bounced, does that mean we have to go back into our books and then put minus cash?
Absolutely. Good insight. You are 100% correct. When we received that money, Josh, it came from a customer, we'll guess, okay? Mm-hmm. When we got that money, we debited cash and we credited accounts receivable. Mm-hmm. Now we find out that the money's not there. We have to reverse that entry. So for the NSF check, you're going to write a journal entry debiting accounts receivable and crediting cash. Okay. You need to write a journal entry for every one of these. Here's a collection. Let's assume that's a collection on a note, maybe with interest. So down that one, we're going to debit cash for $2,600. We're going to credit something else, notes receivable for maybe 25, and notes interest for another 100. Anything on the book side requires a journal entry. Okay. On the bank side, no journal entries, because this is stuff we already know. This is what we don't know. Okay. Bank reconciliation illustrated. They're giving us deposits in transit of 2201. They're giving us outstanding checks, other deposits, blah, blah. Let's see if they make this work out for us. See how they start the bank rec? You start with the balance per the bank and the balance per the book. And they're telling us that the bank collected an electronic funds transfer from a customer. For some reason, this customer sent his payment directly to the bank. Well, that's okay. We debit cash and credit accounts receivable. Check number 443 was a payment on account to Andrea Corporation. I don't know what they're talking about here. The cash disbursement journal shows the check number was a payment on account to Andrea Corporation. The correcting entry is, I have no idea what they're talking about with that. Do they talk about it up here? I think that's a bad slide. Okay. So look at the next one, NSF check. Now here's the one this is the one that you figured out by yourself before I got to this slide. A bounce check becomes an accounts receivable. It was, we had gotten paid, but we didn't really get paid. Bank charges. Now we're looking at the bank statement, and we see that the bank charged us $150. We're going to have to credit cash for that, okay? We're going to have to credit cash like you see here and debit bank charges or some expense like that, okay?
I have another random little question. Say the check bounces. and the bank tells us, oh, well, because you sent us a invalid check, because I know sometimes some banks do that, they now charge you
Yep,
a $5 fee for
yep,
giving me a bad check. Do we
yep.
then charge that to the customer onto a different account?
You bet you
Or
do. You go after the customer for that. Yeah,
okay.
yeah, yeah. Maybe you don't call it accounts receivable. You call it, I guess you could call it accounts receivable. You call it some kind of receivable. Because you get, isn't that the most galling thing? A customer bounces a check and you have to pay a fee because of that.
Yeah.
That's
No,
that's
we
the
can't
worst
have that.
bummer in the world. Well, that's why you check your customers out at first. Make sure that they're pretty reasonably paying. The reconciling, okay. Take a look at this simple question here, because this question might be exactly what you see on the test. A different form maybe. The reconciling item in a bank rec that requires a journal entry. You don't have to do a journal entry for outstanding checks, right? The
No.
outstanding checks are the ones you know about that go on the bank side. Same thing with the deposits in transit and the bank error. But the bank service charges, we don't know about that. We don't know about it until we get the bank statement in the mail. Let's see, Sally Kist has some activity, and they have an NSF check. Okay, what are the treatment for these for? NSF check came through. What do we do on our bank rec? We have to subtract it from our balance, right?
Yeah.
We don't have that money anymore. But we got good news. We saw a credit memo come through, an electronic funds transfer. That is going to be a plus to cash. Outstanding checks, we deduct them from what? The bank side, not our side. And same thing with deposits in transit. We credit them, we add them to the bank side. And then both sides come out with the same adjusted number. Where I worked for many years, we had 3 bank accounts. We had the main one, we had a one just for payroll, and we had a third one, like an impress type fund. And my employees love to do the bank reconciliations. They just love to do them. They thought it was like a fun thing to do. And I had trouble fighting to get them to not do the bank reconciliation, maybe once a year. She was such a nice girl, Chinese girl, Nancy. I say, Nancy, I'm going to do the bank rec this month because the auditor wants me to. I don't want you to do the bank rec. I do the bank. So anyway, hopefully you like to do bank recs. Cash management. Didn't we already talk about cash management? What is cash? Cash is coins, currency, checks, money orders, money on hand, deposits. It's also credit cards. It's wire transfers, okay? All of that is cash. Balance sheet reports the amount of cash at any one time. It's a current asset, huh? Cash equivalents. Cash equivalents. These are like a 3-month CD. If you know what a certificate of deposit is, you can go to a bank and tell the bank, here's $5,000. I'll come back in a year and get it, plus interest.
Yeah.
That would not be a cash equivalent, I don't believe, but a 3-month one would. And it's considered a cash equivalent. And that's an important metric because if you're borrowing money, you can call that cash. Whereas the 12-month one, you really can't call that cash. That's more of an investment. So we talk about cash and restricted cash, cash that is not available for general use. Let me talk about that for a little bit. I had some pretty good experience with that. I worked for about 5 years as the chief financial officer of the Santa Barbara Neighborhood Clinics. I don't know if you're familiar with them in town. I worked at Isla Vista. We had when I was there, we built the East Side Clinic, which we moved. We built a dental clinic in the West Side. Now I know they built one in Goleta. Mm-hmm. We used to get tons of money in from donors, but it would be for a particular purpose. We get $1 million from somebody, from Lady Ridley Tree, if you're familiar with that name. She would send us $1 million, but it would say hepatitis C only. So that money was restricted. I could not spend a penny of it except when Hep C patients came through. And I could only spend it after we spent the money. So restricted cash, that's what that is. You just can't spend it. And
Well, I have a question about cash, because like now we're going into a lot of the like cryptocurrency and all that. Would crypto be considered cash, or would it be a restricted cash because you have to do a certain process, or would it be an investment?
I am going to have to play dumb on that one. I have no
Okay.
idea. I'm an old goat. I'm in my mid-70s. The idea of a crypto cash just blows my mind. I don't even know how it really works, to be
Okay.
honest with you. But I tell you, you're asking a good question for the future. The crypto has lost like more than half its value, though, right? Recently.
It has. Yeah.
So what I don't understand, if it's supposed to be a substitute for cash, how it could lose its value so much. But that's just me.
Yeah. I
Yeah,
think
you're
it's all
gonna.
based off of trust and like willingness of people investing in that specific the currency.
Yeah, as soon
But
as the word investment is introduced, it's not cash.
okay.
I've never paid a bill in crypto, and no one's ever paid me. I wouldn't know what to do with it. You have to talk to Matt Damon, the actor, right? He does the commercial. He'll
Yeah.
straighten you right out.
I got
Which
him on
is-
speed dial. I'll call him in a bit. No.
Yeah.
All right.
Cash is listed first in the current asset section. We kind of knew that. And then here what they're doing. I'm not going to spend too much time with this. They're showing us different activities. Cash and cash equivalents are comprised of coins, currency, and NSF checks. As soon as you see NSF checks, you know that's a bunch of baloney. Restricted cash is classified either as a current asset or non-current. That's interesting, depending on the circumstances. And a company may have a negative balance in its bank account. It should offset this negative balance against cash and cash equivalent. No, you should never have a negative balance in cash, although companies often do. How come they have a negative balance in cash? What would cause that, Joshua?
If they just recently purchased something.
Yeah, and they didn't have enough money in the bank to pay for it. And
Yeah.
they're floating checks is what I'm getting at.
Okay.
Your landlord says, I'm throwing you out of the building tomorrow, Josh, if you don't hand me a check right now for $2,000. So you hand him a check for $2,000. You only have $1,000 in the bank, but you're praying that your customers pay you $1,000 tomorrow in order to cover that check.
Okay.
I mean, it's illegal to do that. You're not supposed to do it, but people do it, companies do it, and it's not a good thing. I've done it. Cash and cash equivalents often include short-term investments, therefore accounts receivable should record. Now, come on. And they're just talking about the operating cycle. This takes us back like 3 chapters, huh? We start with cash, and we start a business. We buy inventory, we bring the inventory in, we sell it, we bill people, we collect, and we start the cycle over again. This operating cycle. I don't know how that slide got in there. It's totally ungermane to what we're doing here. Cash management. Well, what can companies do to work with cash? We want to collect it as soon as possible, right? Way to keep cash under control is, if you can, collect it in 30 days, collect fast, keep inventories low. In a perfect world, you'd have no inventory because you're selling it every day. You're turning it over every day. So low inventory is a good thing. Big piles of inventory stocked around, that's going to cost you a fortune before you know it. And then, of course, you monitor how you're paying your bills and how people are paying you. Invest idle cash. Yeah, we'll talk about that in a moment. Cash budgets. Are you going to be taking 240, Josh?
Maybe. Yeah, I think. Yeah, I don't see why not.
They have an excellent chapter on budgeting for manufacturing place. And one of the big ones is the cash budget. We don't do too much of that in this chapter here, in this course here. But cash budgeting, you keep track of the cash receipts, the cash disbursements, and any other activity involving cash. And I'm just going to show you this briefly. You see where it says beginning balance $38,000, Josh?
Mm-hmm.
And then they have collections from customers, collections here. And let's assume this is a budget. These are not real numbers. This is just their budget. So total receipts are 170 plus the 38 they had above. They have 208,000 available, right? But now they got to pay for inventory, salaries, and those items add up to 182.5. That takes our balance down to 25,500. Okay. That becomes our new balance, as you know, at the beginning of the next quarter, right? And we go through the same process, but this time when they get to the bottom, they only have $12,000. And apparently they have a rule with this company. You must always have $15,000 in the bank. So that's why you see they're borrowing 3,000. So that brings the balance to 15, and you repeat the process. This exact form, you work like quite a bit in one of the chapters in 240, okay?
Oh, and then the interest charge of the 3,100 is basically paying off the whatever they borrowed the year prior, right?
Absolutely right. They said the interest, they borrowed the money for 2 quarters. They borrowed the money for 2 quarters. So that's 6 months. So whatever that calculated out to was $100. It must have been 12% interest. 12, I can't do the math in my head. It was 4% interest probably. $1,200, $1,200 for 2 months, 600, that's right. The interest was $600. It was 2%. That's $600 divided by 50. Divided by 12 equals 50 times 2. That's the part that the students have the trouble with, the easy interest calculation. That always drives them nuts. They do good on all this harder stuff, and then they get to the interest calc and they blank out for some reason. Like I just did. Martian companies management wants to maintain a minimum monthly balance. Ooh. Well, that's nice.
Actually, I have a question on that one. So wouldn't the interest only be the 100? What
the interest is the 100 part of it. The 3,000 is the principal.
Okay, so you include the principal and the interest for the interest portion?
Yeah, because that's the repayment. See, less repayment plus $100 interest.
Oh, okay, I didn't see the repayment part.
Yeah.
All right.
So you're crediting cash for 3,100. You're debiting notes payable for 3,000, and you're debiting interest expense for the 100.
Okay.
Yeah, good question.
Thank you for clarifying.
Wow, what a nice slide. Martian expects to maintain a minimum monthly balance. Okay, let's see what they're talking about. And the subject changes. Well, I don't care what they were talking about. If they're not that interested in showing us, I'm not interested. We'll talk a little bit about petty cash. Petty cash. Think of it as a little box, like a recipe box, filled with small bills and coins, okay? And it's used to buy and pay for little tiny nits and ticks that come up in the course of a day. Have you ever seen a place with a petty cash box at all, Joshua?
No, I haven't.
Okay. Well, typically in any business, the receptionist usually will have petty cash. And typically it's $100, $200. And she's got it there, say $200 to start. And she might have 5 $10 bills, and then a couple of 5s, some 1s, then a bunch of coins. And it's used to pay the things we don't want to write a check for. Somebody comes up from the hallway, they lost 50 cents in the soda machine. We're not going to write a check for that and make the guy wait 2 weeks. So she pays him out of the petty cash. She gives the guy 50 cents, and he signs a sheet that he got 50 cents. UPS shows up, COD, $3. Again, she'll give the guy $3. He signs that he paid the $3 or got the $3. At the end of the month, the petty cash person will prepare the petty cash report, and it's from that report that we record everything. Okay, so if the petty cash box is $200, there always has to be 200, always, either in vouchers plus cash. Okay. Now you can lose money or make money by mistake, and we'll talk about that a little bit too. So this is an important journal entry right here. Class, Laird decides to start a petty cash fund and they debit petty cash, credit cash. So petty cash is now a new item in your chart of accounts. You're going to see cash and below it petty cash maybe. Okay. The petty cash fund is made out to you personally, Josh. You're in charge of petty cash. It's made out to you. You go to the bank and cash it, and you come back with what you want in coins and bills. The custodian, that's you, has the authority to make payments. And the size of the expenditures is limited. If some salesman, I used to fight with these guys all the time, good-naturedly, I hope, all those years. The salespeople were always the biggest pain in the necks to the accounting department. The salespeople, guy would go out to lunch with somebody. He'd spend $60 on a lunch for him and two other people from another company, and he'd try to get $60 out of petty cash. Would I give him $60 out of petty cash? No. I decided that the limit out of petty cash was, say, 20. And he'd give me an argument. I go, come on, Jerry, you can wait 2 weeks for your money, you know? So the size of the expenditure is limited. And the use of the fund is only for certain types of things, blah, blah, blah. And at the end of the month, with the report, the custodian is going to be given a check for all the vouchers, and then he or she's going to go to the bank and replenish the petty cash box. So here's what happened. We're looking now at the petty cash report, pretend, okay? Pretend we're looking at the report, and we see a column that says postage. We have 5 people, different days. Postage totaled 44, freight 38, miscellaneous. We debit those expenses. We credit cash. We credit cash. Let me give you this distraction here. We credit cash. You'll never credit petty cash. You're always going to credit cash when you make these payments. Now here, Josh, we're off by $1. That can happen, right? You run a petty cash, the end of the month, we're short $1. All right, Joshua, you make sure that doesn't happen again, pal. You're in big trouble. $1 off. You could go $1 the other way too, be $1 over. And that often happens. 1 month you're over, next month you're short. Go ahead.
So just to clarify, that means we only do the petty cash sorry, I forgot. Like the debit and credit for petty cash, we only do it once, and then whatever we spend on petty cash, we don't credit the petty cash and then
Nope.
debit it with cash like that. No, we just don't complicate it, and we just do it like this, and then the petty cash stays at 100, but cash keeps going down.
Yep. Okay. You only credit cash. You will never ever touch petty cash again unless you decide you want a higher petty cash or lower, or you want to get rid of it. Okay.
All right. Thank you.
And that brings us to the end of our chapter. This is IFRS stuff, which we ignore. You might see it a little bit on your homework, but we don't go into that on tests and the real curriculum. So what do you think, Josh? You learned a little something, I hope, to get you started on the homework?
No, yeah, most definitely. Yeah, I haven't read the chapter, but this it all makes sense. For me, the hardest part was the beginning of the course, which was like learning all the terms and understanding the stuff. But as soon as we got into the the numbers part, it's been pretty easy for me.
Good for you. Are you pretty good with the debits and credits now? What gets debited, what gets credited?
Yeah, the more practice I'm doing and the more homework, obviously, then it becomes more like second nature, I guess. It just makes sense now.
That's good to hear. Good to hear. All right, I guess we'll call it a meeting then, huh, Josh?
Perfect. Thank you for your time.
Well, good. Have a good session at the gym. All right.
All right. Thank you.
I'll see you later.
Stay safe.
Bye-bye.